Okay, so we've seen those interest rate decreases as predicted last month come through, and they've been even better. So we're going to talk about those rate decreases. We're going to talk about what that brings for the next year, some of the predictions that we're going to make. We talk about 2-year fixed, 5-year fixed tracker options when it comes to mortgages. We talk about the type of schemes that are out there right now on the right to buy, debt consolidation. We look at down valuations, and I've put all of these in a key in my description. So if you're not interested in right to buy council flats, then you can obviously just click onto the notes and it will take you through to the next section. So they're all sectioned out. Like and subscribe as always. Let me know what your thoughts are. As always, it does really help us when you do comment, as well as liking and subscribing and sharing the videos. And I'll catch you on that video. Take care. Hello everybody, hope you're well. Happy New Year to you and all your family members. Right, 2024 has started with a big bang when it comes to mortgage rates. It's good news for everybody really. Rates have dramatically decreased in the last couple of weeks. Certainly in the last week we've seen some big announcements by some of the major lenders out there, and they have reduced rates, and we've seen for the first time rates come below 4% on a 5-year fixed and around the 4.5% on a 2-year fixed. So major improvements to where we were sort of last month. And that's fantastic really. So some major lenders coming in under 4% now on a 5-year fix. That's telling us that the market is pricing in a number of rate decreases this year. I've been sort of on the record to say, look, I did think interest rates were going to come down. We've seen the Fed come out and said they think there's going to be 3 interest rate decreases in America. And I think the Bank of England will follow suit. Whether it's going to be 2 or 3, it's certainly been priced into the market. So some good news. At the moment, we're seeing these rates that I've quoted are going to be for people that have got big deposit amount. I would say typically around 40% deposit, but we are seeing good rates right up to sort of 85%, 90% loan to value. So it's tiered. So the more deposit you have, the better the rates are, but that's a trend right the way through. So really, really good. Obviously, there's a lot of people, around 200,000 people every month, they're going to be coming off their 1% rates and going in these rates, so they may not feel it as much, but it's certainly a better place than we were last year. Now, because of this, the choice of going for a 2-year or 5-year fix is going to be really, really important. Remember, for those people that have got 40% deposit and are what I would say in a stable environment with their occupation and so forth, a lot of people I'm seeing now are opting for the 2-year fix because they're envisaging that yes, there's going to be rate decreases, or they're looking for tracker deals or deals with no early repayment charges. So there's a lot of movement around that. Some people just want the security. Maybe they don't have as much equity in their property and don't want to be falling into negative equity, so they're tending to go for the 5-year fixes. So there's a lot going on. I think it's prudent to wait and see. If your mortgage is coming up for a couple of months, get in touch with a mortgage broker now. Get them to do some work for you. We're doing that for our clients. We're doing some initial research, finding out when their actual date is coming up. Obviously, it doesn't make sense to remortgage now because they're on a better rate. However, up to 6 months before now, we're doing calculations for people, because let's just say I come up with a rate now and we go for the actual product and the lender comes out with better products. As long as we give it a couple of weeks until your end time, we can actually go back to the lender more often than not and just say, look, we can see you've got a new rate for new customers. We've got a mortgage offer on this rate. Can you give me the new rate? There is a caveat in that. I've seen solicitors or conveyancers add on, some of them are adding on additional administration fees for new offers up to £50, £80. So they're saying if there's another new offer, if there's an adjustment to the offer, we'll have to do more work and we're going to charge for that. So you just got to bear that in mind when you are going for such policies. A lot more, this will really help for affordability as well. As rates come down, stress testing calculations will get better, which means the affordability calculations get better. So overall, quite a positive start to the year. We've also seen this reflected in the buy-to-let rates. I've seen quite good improvements on buy-to-let rates. In fact, I've just quoted a client of mine on a buy-to-let product with no fee, which is quite unusual, and it actually fits rental calculation on a pretty decent rate. So buy-to-let rates have also dropped down, which means there's going to be more activity, certainly on the remortgage side. We are still seeing purchases happen, and there's quite a lot of activity within the purchase market as people have been sitting it out and waiting to see what's going to happen. What I would say is you've got to bear in mind all of this is because of the slowdown in the economy, and whenever there's a slowdown in the economy, this is followed by job losses. So what I'm envisaging is a lot more job losses. I know personally a lot of my friends are going for restructures and all sorts of things. So you just got to be mindful. You don't want to be hitting a mortgage and then you're going for a restructure, or there's uncertainty with your occupation, and always discuss that with us if that is the case, because that's seen as a material change. Certainly if there's if this is happening while you're going for a mortgage application, I would question why you would want to do that in the first place, certainly if it's a purchase. The type of deals that we're doing right now, lots of remortgages on a like-for-like basis, a lot of home improvement stuff. People have been holding out, maybe not buying that property and doing the extension, so a lot more of that. Debt consolidation, we're in January, people have spent too much money, they're going for debt consolidation. Lots of issues around debt consolidation. People need to be careful by just because it sort of looks headline that you're going to debt consolidate a credit card or a loan into a mortgage. Remember, you're putting that into a long-term vehicle. It's also secured against your property, where a credit card is not secured against your property. So careful consideration. Just because it looks cheaper initially, it may not work out to be cheaper. And there's a lot of worry with lenders around debt consolidation. Lots of lenders have got policies specifically on debt consolidation, whether they'll allow you to debt consolidate up to a loan to value limit, whether there's an actual sum, maybe £30,000 or £50,000. There are other lenders that if you are debt consolidating, they don't care whether you're going to pay it off or not. They'll use it into calculations. So if you've got a £20,000 loan and you're paying £300 a month, they'll even take that, even though you're going to pay that off, they'll take that into affordability. So lots and lots of, and you definitely need advice around debt consolidation. I would say if you take anything from this video is, if you're looking to debt consolidate, get some advice around this, because it's not straightforward. What else am I seeing with lenders? Well, I'm seeing lenders reprice. I saw one lender reprice twice this week. I've seen another one, I think, reprice 3 times this week. As lenders come in, and we've seen some major lenders like HSBC, we've seen the Co-op Group, we've seen NatWest, we've seen a lot of the specialist lenders all reprice their products down. Okay, so there's going to be some reaction to other lenders that haven't been so fast off the block. They're going to start repricing down. So it's a good environment to get a overview of what's happening because of this. Now, I've also recently just wrote an article on offset mortgages, okay, and I want to touch on offset mortgages because people do not recommend them enough and people don't know enough about them. An offset mortgage is essentially a mortgage whereby you've got your mortgage and then you've got a savings account that's linked to the mortgage, and instead of paying the interest on the mortgage, the bank will give you a nominal savings rate, which basically means your savings, your interest rate comes down because they're doing a blended rate between the savings and your mortgage rate. So there are some good advantages on that, and check out my article. I will leave a link below to offset mortgages. The positives around offset mortgages is obviously you've got this savings account, so you can have access to that money because it's there, and you can almost use it as a overdraft facility essentially. You've got that. It's great sometimes for tax purposes from an offset account. Some of the downsides of an offset account is it's quite hard to remortgage from one lender to another. Not many lenders offer it. So again, your choice is not that great, which means the rates are not that great. So sometimes you've got to make it worth your while. Is it worth doing it? Because you're going to be paying a higher rate, especially right now as lenders are trying to fight for that business. It's the beginning of the year. Lenders have got targets. I told you, these lenders have got huge overheads and they've got targets. They need to lend. The Bank of England base rate's somewhere else and they're lending somewhere else. So that's telling us where they think it's going to go. Like I said, if you can make it work, maybe a tracker option is a good option at the moment. If you can go for a tracker deal, because as rates come down, your tracker rates will also come down as well. So that's the best of both worlds. Ideally, a tracker with no early repayment charge. So if there is a real good rate out there, you could swap and go onto that tracker product. What you'll typically find with tracker deals is you typically pay a lending fee. So you've got to take that into account. If you're paying £1,000 lending fee, does it make sense if you're going to move across in a year's time to a different lender? But like I said, I'm seeing more trackers, more 2-year fixes certainly than 5-year fixes historically. There are some ways where it's probably best to go for a 5-year fix. Like I said, high loan to value deals, maybe things like right to buys and things like that you're fixed in for a certain amount of time. Or if you are remortgaging at a high loan to value and you've basically taken the money out already. So what are you going to do in 2 years' time? You're going to have to pay another lending fee. So there are different reasons why you would go for certain choices. When it comes to, we've seen the right to buy papers go out. So these are the people that are getting council discounts on their properties to purchase their properties. Just touching on right to buys, one of the biggest issues that I'm seeing with right to buys right now is the type of clients that are going are typically first time buyers. They're obviously being council tenants. And yes, the discounts are good on right to buy. So you get a big chunky discount, £128,000 odd, sometimes as much as, but you still have to make the affordability work, okay? I'm doing a lot more right to buys with family members. So mother and father have got the right to buys. Children live at the property. Children are actually the earners. Mother and father are too old. So we're buying together. You just got to be mindful on those family type mortgages when you are looking to buy with parents and so forth. You know, that's all great initially, but what happens if the children want to then buy other properties in the future? They're tied into that property. So it's not just initially trying to solve a solution. It's what's going to happen in the future when you are looking to move on. And I've come across this quite often now where this has happened maybe 3 years ago, 5 years ago. They bought a property. Now they want to move on and they find themselves, they're stuck. What do they end up doing with this property in their name? Parents can't afford it. They need to be on there and it becomes difficult. So, and that's not just on right to buys, any type of family lending, cross family lending that I'm seeing a lot. That's one of the biggest problems. Gifted equity is another way. So I'm seeing more gifted equity. This is whereby say mum and dad you all live in the same property. Mum and dad can't get a mortgage. They're too old or they're not working and they're going to sell the property to their children. Okay, so it's called the gifted equity because essentially, say the property is worth 400,000, they're going to sell it to the children and then use the equity, the 200,000, and maybe get a 200,000 pound mortgage as a deposit. So the children can use that because the equity is being gifted. So rather than them selling it and there's cash exchange, they're just exchanging the equity. So I'm seeing more and more of that. And not many lenders do it. I mean, there are some high street lenders that will allow for this to happen, but there are all sorts of legal issues around it. So a lot of lenders have actually decided they will not do that. Or if they do it, they want the parents out of the property. Now, what I'm doing a lot more of is the parents actually remaining in the property. So they gift the property, but they actually remain in the property. And that's called the gifted equity deal. And like I said, there are high street lenders that will enable you to do it. And there are other high street lenders that will say, yeah, we will accept it. However, the parents need to be out on completion of the mortgage. So bear that in mind. Down valuations. Right. I'm seeing more down valuations across the board, whether it's a residential or buy-to-let. Generally on remortgages, this has always been the case on remortgages. I'm seeing more of it because surveyors are nervous. People think generally their properties are worth more. That's for one. Buy-to-let investors always think their properties are worth more, especially if they've done a refurbishment on it. So they think they've done a refurb in a top standard and other properties are worth what they're worth. The surveyor goes there and says, no, actually, it's not as much. I'm not seeing huge down valuations, I have to be honest. So we're still managing to make the deals work. But there's, I would say I saw 4 down valuations last week on cases, 3 of them on buy-to-let, 1 on a residential. I've also seen a down valuation, a couple of down valuations on purchases, which is unusual, but it's the sign of the times. Basically, the seller wants this. The surveyor goes and says it's actually worth this on a purchase. So then there's a bit of negotiations between the buyer and the seller to see if they can make the deal work, because the lender will go, well, I don't care. We're going to go with what the valuer says, which means you have to put more deposit down. Generally, that's the way it works, right? They're not going to sort of be persuaded, and I can, not many times they get persuaded back, even if we give them the sort of, comparisons and so forth. The lender generally says, no, sorry, we want, this is what the surveyor said in our opinion, and that's what we're willing to lend. So I've seen them on purchases. I see it a lot more on remortgages, but you've just got to be mindful. Sellers want a certain price. The valuers are nervous. They don't want to be getting sued, so they go in with a very conservative figure, because you got to understand a mortgage could take up to 6 months to complete. So they're basing it on right now, as well potentially as what it's worth when it's completed. So, and all sort of directions are pointing to certainly a little bit of down valuations, the valuations being under pressure this year. So yes, rates are coming down. Yes, it's all great news, but the reason behind that is because the economy is doing really badly. Okay, so and that's reflected in why there's a panic, and why there's a panic that's going on now. This is all based on inflation figures falling, but of course we've had the war in the Middle East. We've had all these issues. We've had all these issues around the ships now being circumventing around Africa. I think all of that stuff will have an issue. That will come by when inflation figures come out. There could be, if this is prolonged, this will have a dramatic impact on oil prices and commodity prices and imports. So, and we are an importing nation, so we're not out of the woods yet. But I think, get them while they're hot. The rates are there. Lock in if you can, and then we can always, like I said, you can always tailor it. You can always try to go back to the lenders and fine tune things later on. Let me know what you guys think. Let me know what you're looking to do this year. Are you looking to remortgage? Are you looking to buy a 2-year fix, 5-year fix, tracker deals? Let me have your thoughts on where you think we're going to be during this year, and I'll catch you on the next one. Take care. The content of this video does not constitute giving advice. It's purely for information purposes. All cases should be discussed with a professional mortgage broker. As a mortgage is secured against your home or property, it could be repossessed if you do not keep up mortgage payments. Niche advice is authorized and regulated by the Financial Conduct Authority.